friends. Today's video is about Elliott waves. We will study about Elliott waves, the motive waves, corrective waves, and then we will apply all these concepts on Bank Nifty. Then we will learn about a pattern known as ending diagonal, and then we will follow up with some case studies. So basically Elliott waves is just any other form of technical analysis. Impulsive waves that set up a pattern and corrective waves that oppose the larger trend. The waves in the direction of trend are known as motive waves, whereas the wave opposing the larger trend are known as the corrective waves. In the figure, we can see 5 waves: wave 1, wave 2, wave 3, wave 4 and wave 5. These waves form the motive wave, and then there is a correction in the form of wave A, wave B and wave C. These are known as corrective wave. As you see, we can see a candlestick chart and 5 wave structure. We can see wave 1, wave 2, wave 3, wave 4 and wave 5. This is an impulsive move. It is hardly impossible to know when wave 1 starts, but once it is formed, we can be sure about the rest of the waves, and it is easy to trade the rest of the waves. Once wave 1 is formed, you can easily identify that where wave 2 will be formed. Like in the chart below, we can see at exactly 38% retracement, wave 2 was formed. All the 5 waves internally are divided into subwaves. Like wave 1 is divided into 5 subwaves, and wave 3 is divided into 5 subways. Similarly, wave 5 is divided into 5 subways. The corrective wave 2 and 4 are divided into 3 subwaves, A, B, C. So if we apply all these concepts on the chart, we can see previously we have marked the 1, 2, 3, 4, 5 wave, but the first wave is itself divided into 5 waves. The wave 1 to 2 is divided into 3 subwaves A, B, C. The wave 2, 3 is divided into 5 subwaves 1, 2, 3, 4, 5. And wave 4 is divided into 3 subways A, B, C. And then 4 to 5 is divided into 5 subways 1, 2, 3, 4, 5. So now let us see what are the characteristics of wave 1. While wave 1 is forming, the sentiments are very bad. There is a prior correction that is going on, but surprisingly the volumes are very high during wave 1. Like some big institution is started to buy some stock. These are the early signs of wave 1. Since there is a correction already going on in market and the sentiments are very bad, it's almost impossible to trade wave 1. Wave 2 have some important characteristics. Like the very most important rule is that wave 2 cannot retrace 100% of wave 1. The wave 2 has a very low volume since this is a retracement. It is the best time to enter, and it is just the start of the bull market. Wave 3 is typically 161.3% of wave 1, but it can exceed. Generally, during wave 3, the sentiments are very good. There are a lot of good news that are coming and the volumes are picking up. During wave 4, there is a sudden disappointment in the market. The disappointment can be bad results or any bad news. For the wave 5th, it is also known as retailer's wave. The up move is very on based of low volumes. And everyone is just talking about the stock that it has a bright future, but we know how that ends. If you summarize all these points, we can see wave 1 is formed right at the bottom. Once it is formed, there are a lot of negative news in the market. There are a situation of panic, wars, and everyone is frightened. Once wave 1 is formed, there is a retracement back wave known as the wave 2. And basically fundamental conditions are often as bad as worse at the previous bottom. Once wave 3 is formed, the fundamentals become better and better. The underlying trend is considered up. Wave 3 is never the shortest waves out of all waves 1, 2, 3, 4, 5. This is one of the most important tools you have to figure out. Once wave 4 is formed, we can see there is a certain disappointment. The disappointment can be in forms of results, numbers, or some bad news. After this wave 4, a wave 5 is formed, and again people start to buy. But you can see the market performance in fundamentals improve, but not to the levels of wave 3. And experts think the stock is now overvalued. So now let us see one important case of ending diagonal. So basically there are two major types of Elliott wave structures, motive and corrective. And within these two categories, motive wave includes impulsive waves and ending diagonals. Zigzag, flats and triangles are all corrective wave patterns and are not part of this video. So basically ending diagonal is an easily discernible wave pattern. It looks like a rising wedge pattern in case of uptrend and falling wedge in case of downtrend. So basically the difference in this pattern is that the ending diagonals can only form in the fifth wave position of an impulse wave or the wave C position of an ABC formation. Mostly people are confused when to buy options, and ending diagonal is one of the best case when you can buy an option, because the pattern it tends to be swift, retracing the entire length of pattern, and we see sudden quick movement after ending diagonal is formed. Let us see the rules. Ending diagonal consists of 5 waves labeled 1, 2, 3, 4, 5. Each wave subdivides into a zigzag ABC or WXY. Wave 1 and 4 overlap in price. Wave 1 is usually the longest. Wave 3 cannot be shortest among wave 1, 3 and 5. Ending diagonals occur in position of wave 5 of an impulse or wave C of a correction. You can see this is formed both in case of uptrend. This is also known as a rising wedge pattern, and in downtrend a falling wedge pattern is formed. Not all rising wedge are bullish or bearish. It generally, if this is formed in a wave fifth or C, then only it is bearish. So let us see, this is the chart of Bank Nifty, and you can see during Corona market crash it formed an ending diagonal pattern. You can see this is the fifth wave, and on when price starts to trade below the fourth wave there is a sudden crash. So this is the case when options should be bought, and you can see how fast the movement comes. This is the fifth wave, and once price starts to trade below this fourth wave, which is the internal sub of the fifth wave, as fifth wave is a 5 wave structure, so 1 2 3 4 5, and you can see once price starts to trade below the fourth subwave of fifth wave, there is a crash. Whoa. If you are enjoying the content, please like our channel because it really helps our channel, and if you are new, please consider subscribing. So now let us see some case studies before we wrap. This is the chart of AUD USD, and you can go and see this chart pattern. You can see this is the case of an ending diagonal. Once the price trades below the fourth subwave, you can see price immediately crashing. One important characteristic of this ending diagonal is the concept of throwover, which means price starts to trade above this trend line and then immediately comes back. This concludes our theory that the price will soon move below this fourth point and there will be an immediate downtrend. Let us see another chart of gold. You can see the price once moves above this fourth subwave starts a new bull trend. I hope this clears the doubt of many viewers regarding Elliott waves. If you have any questions, please comment and I will get back to you. Thank you and have a nice day.